welcome friends to this NPTEL MOOC module on international trade theories and empirics. We are in the 10th week of its progress, and so far in this particular week we have started discussing about exchange rate dynamics, especially exchange rate overshooting aspect. And also we have addressed the role of reserves, money demand, money supply, okay. And also we talked about in which time period it works, and the exchange rate overshooting model works. And in addition to that, we have started discussion from the beginning of this week on monetary approach to the foreign exchange market, okay. So, as we already understood that it is largely a monetary phenomenon, hence our discussion further will be emphasizing on the role of the apex monetary institution of India and across the globe. Now, this particular lecture is targeted to understand how exchange rate is determined in the short run. Okay. We know that in the short run, given the fixed exchange rate regime, it is not so effective. So, exchange rate might overshoot, but some of the results in the from the different literature suggest that it is actually not always correct. Okay. So, therefore, we wanted to understand what do you mean by short run exchange rate. Okay. So, especially after the collapse of the Bretton Woods system in 1973, where the pegged exchange rate was abolished and the floating exchange rate was followed. Especially after the Bretton Woods system and its collapse, country adopted steadily on the volatility of its exchange rate. And in the floating system, the exchange rate gets automatically adjusted and reflected in through its prices. Okay. Since then, a lot of research has been undertaken to get the understanding of the behavior of exchange rate movements. Okay. Some of the perennial questions that were raised are, for example, what are the determinants of foreign exchange rate? Do foreign exchange rates follow a specific pattern? Okay, then is there any theory that can help us predicting the rate of movements? Okay, and accordingly we can understand macroeconomic changes that affect foreign exchange rate, interest rate and price levels may also affect output. This particular chapter where we are referring is from this chapter we are referring from Krugman and Obstfeld book on international trade. In that chapter introduces a new theory of how the output market adjusts to demand changes when product prices are themselves slow to adjust. A short run model of the output market in an open economy will be utilized to analyze. So, the short run aspect is emphasized as per the title of this particular paper or particular module. In the short run specifically we are going to emphasize the effects of macroeconomic policy tools on output and the current account. The use of macroeconomic policy tools to maintain full employment is also important to be discussed. So, the first question that needs answer that was on what are the determinants of aggregate demand, determinants of exchange rate determination. We need to first address the determinants of aggregate demand in an open economy system. So, obviously, in an open economy system we will have to include the open economy market. Okay. So, what is the aggregate demand once again, since we have already read macroeconomics and where aggregate demand is discussed from the beginning of the chapter. The aggregate demand is the amount of a country's goods and services demanded by households and firms throughout the world. Okay. The total goods and services demanded vis-a-vis other countries in the world. The aggregate demand for an open economy's output consists of 4 components majorly. These 4 components are consumption demand, investment demand, government demand and current account. Okay. So, these 4 we need to understand that what are those 4. Okay. So, consumption demand, investment demand, government demand and current account, where the transaction in the current account and the entries are important so far as open economy discussion is relevant for understanding the short run foreign exchange market. So, other 3 aspects I am now discussing in detail, like consumption, investment, government. I am emphasizing here now on current account. Okay. In the current account and its determinants, which talks about that the current account balance is viewed as the demand for a country's exports less that of the country's own demand for imports. So, total exports minus total imports is discussed in the current account balance. The current account balance is determined by 2 main factors, that is the domestic currency's real exchange rate against foreign currency. So, the domestic currencies real exchange rate, that is through the prices, okay, the exchange rate divided by the ratio of prices. So, basically this is the ratio of prices, okay, price of the in the foreign market, price in the foreign market divided by the price in the domestic market. So, now YD here refers to the disposable income, which is relevant to address the issues of current account and its balance. So, how real exchange rate changes affect the current account? We wanted to discuss that an increase in the quantity raises the export and improves the domestic country's current account. Okay. Each unit of domestic output now purchases fewer units of foreign output, and therefore, foreign will demand more exports of our commodity. All right. An increase Q can raise or lower import and has an ambiguous effect on current account. So, import denotes the value of imports measured in terms of domestic output. So, there are 2 effects of a real exchange rate. One is majorly called volume effect, where the size of the export and import matters, and second one is called value effect. The volume effect, where the effect of consumer spending shift on exports and imports quantities, then in terms of value, it changes the domestic output worth of a given volume of foreign imports. So, the worth of that exchanges are important in case of real value effect of real exchange rate. Whether current account improves or worsens depends on which effect of a real exchange rate change is dominant. If the value effect is dominant, then accordingly we can find out the implications, and otherwise we can also note down the change. We assure that the value effect of a real exchange rate change always outweigh the the volume effect, that is quantity, always outweigh the value effect. Okay. So, quantity Q is more important than that of the value, it is more important than that of the value effect in the foreign exchange market. Now, we are explaining here the current account determination through the factors. Okay. So, now there are some marking through the arrow that when the real exchange rate increases, the effect on current account is positive. Okay. That and the real exchange rate decreases, then it has negative implication on the current account. Similarly, so far as disposable income is concerned, when it increases, it has a negative impact on the current account balance, and when disposable income decreases, it is just the reverse. Okay. Now, the equation of aggregate demand, which we have already started discussing, that there are 4 important components we discussed. One is in the consumption demand, then investment demand, then government expenditure, then current account balance. So, here the disposable income is mentioned y minus t, c is a function of y disposable, y d, this is basically y d, investment demand, then government expenditure, the current account where real exchange rate is taken, and as a function of the disposable income as well, y d is also equally important. This equation shows that how aggregate demand can be written like the d is a function of exchange rate, disposable income, investment, and government expenditure. Okay. Now, coming to the real exchange rate and aggregate demand, with the increase in quantity raises current account and its demand. Okay, it makes aggregate demand it makes domestic goods and services cheaper because quantity increases related to foreign goods and services. It shifts both domestic and foreign spending from foreign goods to domestic goods. Okay. A real depreciation of the home currency raises aggregate demand for home output. A real depreciation lowers aggregate demand for home output. Okay. All right. Now, coming to the equation of the aggregate demand through real income and aggregate demand. A rise in domestic real income raises aggregate demand for home output. A fall in the domestic real income lowers aggregate demand for home output. Okay. And accordingly, it has implications for the change in the current account. All right. So, then how output is determined in the short run, that is the second question we asked from the beginning, as mentioned in the Krugman-Upseld book, that output market is in equilibrium in the short run. When real output, that is y, equals the aggregate demand for domestic output, that is y is equal to the aggregate demand. Aggregate demand here we are mentioning as a function of aggregate demand. Okay. So, these two whenever are equal, then we get a output market equilibrium. Now, in terms of diagram, aggregate demand and output we have taken in different axes. When output increases, so aggregate demand is expected to be higher, and then if aggregate demand is always in balance, that is aggregate demand is equal to d is equal to y. Okay. If it is a 45-degree line, then we have a point where the demand settles at y1 level. Okay. Then we can have a different point of discussion, like if it is not in balance, basically this is the aggregate supply or aggregate output, and aggregate demand is mentioned here, which cannot be 45-degree line always. Okay. So, aggregate demand and aggregate supply, wherever it matches, we get the equilibrium. If it is below to it, there will be underemployment equilibrium, as we already read. Okay. And otherwise above to this, there will be excess supply that will automatically adjust and get back to the original equilibrium level. Okay. So, now with fixed price levels at home and abroad, a rise in the nominal exchange rate makes the foreign goods and services more expensive relative to domestic goods and services. Therefore, we can expect higher exports, and there will be correcting impact on the exchange rate. Any rise in quantity will cause an upward shift in the aggregate demand function and expansion of output. a fall in the quantity will cause output to contract. Now, based on this, now we are mentioning the adjustment process. So, this is where the perfect matching equilibrium point, but the aggregate demand is not always matching with the balance condition. Here is the point of equilibrium. When in this case the actually currency depreciates, because our aggregate demand exceeds than that of the balancing condition or the equilibrium point. And like when basically currency depreciates, what really happens, the aggregate demand increases. When the domestic currency depreciates, the domestic currency is domestic goods are cheaper in the international market as against the foreign currency. Okay. So, the aggregate demand increases, and there will be a shift, forward shift, upward shift of the aggregate demand curve. So, we land with a higher equilibrium point, that is y 2, and and accordingly there will be a different equilibrium point. So, the factors that shift the demand schedule, which I have just discussed, are here we have said depreciation. Now, other factors could be government expenditure or government purchases, like contraction impact will be there through taxes. There will be investment which is impacting the aggregate demand positively. Okay. Domestic price levels also, foreign price levels, then domestic consumption, demand shift between foreign and domestic goods. A disturbance that raises aggregate demand for domestic output shift the demand schedule to the right. Okay. And accordingly there will be other implications. We will combine the interest parity condition with the money market to derive the asset market equilibrium in the short run. We need to combine the interest parity condition to discuss along with the money market to the asset market. The interest parity condition suggests that foreign exchange market is in equilibrium, where R is equivalent to the R star, that is the interest on the foreign currency deposits, plus the expected future exchange rate, that is E expected minus the exchange rate. Okay. The R is the interest rate on the domestic currency deposit. So, domestic currency deposit whatever we have, the interest rate on it is called R. R is basically the interest rate we get it from the foreign currency deposits plus the expected future exchange rate. The interest rate whatever we will get it from a domestic currency deposit is a function of the rational expectations between the changes in the exchange rate as well as the deposits in the foreign market. So, three aspects are important immediately. This is what is called interest parity condition. Okay. This takes into account the expected change in the exchange rate, as well as it also takes into account the interest rate of the two markets. So, R satisfying the interest parity condition that must also equate the real domestic money supply to aggregate real money demand. So, money supply, the real money supply should be equal to the demand for money, which is a function of the interest rate and the disposable income of the country. So, aggregate real money supply, that is L R Y that rises when the interest rate falls, because a fall in R, that is domestic interest rate, makes interest bearing non money assets less attractive to hold. Okay. Then coming to the a schedule. Okay. The schedule that we are going to discuss right now, this the schedule which shows all combination of exchange rate and output that are consistent with equilibrium in the domestic money market and the foreign exchange market. So, wherever this equilibrium carries, we say the AA schedule. All right. Now, here the output and exchange rate in asset market equilibrium, the first quadrant and the second quadrant. First quadrant we discussed that the exchange rate and the domestic interest rate, it is inversely related to each other. When the domestic interest rate increases, exchange rate falls, and vice versa. So, the domestic exchange domestic currency return on foreign currency deposits is highlighted in red color. Okay. Then how it is connected the money demand. Money demand is actually is a function of your the domestic interest rate and the real domestic money holding. So, money holding in terms and its real money holding and the interest rate, it is actually again inversely related to each other. Okay. Now, the first part we refer to the foreign exchange market, second one is we refer to the money market, okay, and the relationship we have discussed. All right. If the real money supply is somewhere pegged at MS divided by P, that is real money supply, then we can discuss about the equilibrium in that market. All right. And accordingly we can discuss whether there will be a shift or not, and how in the international market we are settled. For asset markets to remain in equilibrium, a rise in domestic output must be accompanied by an appreciation of the domestic currency. Okay. Whereas, a fall in domestic output must be accompanied by a depreciation of the domestic currency. Okay. So, rise in the output is always accompanied by an appreciation in the domestic currency. Okay. So, then how to derive that A schedule which I have just discussed. Basically, it relates exchange rates and output levels that keep the money and foreign exchange market in equilibrium. This slopes downward because a rise in the output causes a rise in the home interest rate and a domestic currency appreciation. Okay. Whereas, coming to the A schedule, once again we are relating exchange rate to the output, it is negatively sloped, and with the when the output increases there will be the exchange rate actually decreases. All right. The factor that shift the A schedule is like the domestic money supply, then the domestic price levels, the expected future exchange rate, foreign interest rate, shift in the aggregate real money demand schedule. So, all those could able to shift the aggregate foreign exchange market along with the output. Okay. So, the balance that is reflected in AA, which relate to the exchange rate and output. Other factors than these two actually are responsible for shift in the AA schedule. What do you mean by short-run equilibrium for an open economy? We have discussed those things, those prerequisites. Now, we are going to apply it for our analysis. A short-run equilibrium for the economy as a whole must bring equilibrium simultaneously in the output and asset markets. That is, it must lie on both demand curve and the A schedule. Okay. Then in this diagram, the short-run equilibrium is explained through the interaction intersection between the DD curve and the AA curve. The foreign exchange market and output equilibrium is explained with the A schedule, and DD the aggregate domestic demand diagram. Wherever they are matching each other, it determines the equilibrium exchange rate and output. Okay. How the economy reaches its short-run equilibrium, that is important to address. There will be automatic adjustment or not. Let us have a look. If the equilibrium breaks somewhere or it is somewhere different, then what it is going to happen, there will be automatic adjustment. okay, between the output and exchange rate, and accordingly it will again come back to the final equilibrium and settles at point 1. All right. Now, there are some temporary changes for sure in the short run. So, there are broadly two types of government policies, and one is called there are two types of policies, one is called monetary policy and another is called fiscal policy. In this context, the monetary policy works through changes in the money supply, whereas fiscal policy is through spending or taxes by the government. The temporary policy shifts are those that the public expects to be reversed in the near future and do not affect the long run expected exchange rate. Okay. Assume that policy shifts do not influence the foreign exchange interest rate and the foreign price level. So, in short, we can able to mention that regarding the short run equilibrium, we need to summarize that the aggregate demand for an open economy's output consists of 4 components, those consumption, investment, government spending or government demand and current account. Output is determined in the short run by the equality of aggregate demand. This is what a diagram refers to, equality of aggregate demand and aggregate supply. The economy's short run equilibrium occurs at the exchange rate and output levels. Okay. So, with the AA and DD schedule, we explain that economy short run equilibrium occurs at the exchange rate and output levels. Other details, I think connection with the exchange rate and the output in the long run we will discuss in the next class. Okay. With this, I think I am concluding and closing the lecture here. Thank you.